Okay, let's go ahead and go through the solution to that first 2-year sample translation problem. And again, we have the big company bought 80% of little company on January 1st, 2020 for 400,000 euros. The fair value of the non-controlling interest was 100,000 euros on that date. The book value of the company was 500,000 euros, and all assets and liabilities had fair values equal to book value, so there's no differential here. We have a trial balance as indicated and the relevant exchange rates below. The first order of business, of course, is to recast this from euros to dollars. So first, for translation, assets and liabilities are going to be converted at the current or end of year exchange rate, so $1.30 per euro. Our paid in capital account, common stock, is going to be converted at the historic exchange rate from when that company was acquired. So that $1.20 exchange rate from January 1st, 2020 is cast in stone. We'll always use that exchange rate. Retained earnings. In subsequent years, we'll carry this value forward from the preceding year in the dollar-denominated worksheet. For the first year of ownership, we're going to use the exchange rate from the date of acquisition. Dividends declared, we'll convert that at the dividend date rate. And revenues and expenses, we're going to convert that at the average rate over the course of the year. So once we get those exchange rates in, it's simply a matter of multiplying across and getting all those values. Okay, so we've got our values multiplied by the appropriate exchange rates to get the correct dollar values for those various financial statement elements. And now we need to figure out what sort of debit or credit plug figure we need to make this thing balance. So we add up our total debits, assets, dividends declared, and expenses totaling 1,156,800. We add up our total credits, liabilities, common stock, retained earnings, and revenues totaling 1,104. And so to make this thing balance, we're going to need a credit of $52,800. And so that's going to be our other comprehensive income translation gain. Next, we're going to need to go ahead and do our equity method entries. And so the first order of business there is going to be we have to figure out what is our dollar-denominated income. So dollar-denominated revenues are $244,000, dollar-denominated expenses $183,000, for dollar-denominated income of $61,000. So our equity method entries. First, our acquisition. We're going to go ahead and purchase 80% of their stock for 400,000 euros, $480,000. Income, our share, 80% of the reported earnings of $61,000 is $48,800. Dividends, our 80% of the $24,800 in cash dividends is $19,840. And then other comprehensive income, our share of the $52,800 translation gain is $42,240. So we're going to go ahead and show a translation gain on the parent's income statement of $42,240. By the same token, we need to do our elimination entries as well. And really there's not a whole lot new going on here. The only thing that's new is going to be the existence of this translation gain. Our S entry, we proceed as before, eliminating the beginning of year owner's equity accounts and splitting that total 80-20 between the investment and the non-controlling interest. In eliminating our investment income, we now have two components to investment income. We have our regular investment income of $48,800, and we also have to eliminate our other comprehensive income from the investment as well. Dividends are eliminated in the usual fashion. And now for the income to the non-controlling interest, again, we have two allocations of income to the non-controlling interest. We have the allocation of the regular earnings, 20% of $61,000, and we also have the allocation of the other comprehensive income, 20% of the $52,080 other comprehensive income. Okay, let's go ahead and move on to 2021. And before we do that, let's go ahead and fill in that number for retained earnings for 2021. Again, as I mentioned earlier, the retained earnings figure gets carried forward from the previous year's dollar-denominated worksheet. So in dollars last year, Little Company had beginning retained earnings of $420,000. We add their dollar-denominated income, We subtract their dollar-denominated dividends, and we get dollar-denominated ending retained earnings of 546.2, which is what we carry forward onto our worksheet for the following year. Okay, let's go ahead and put in all of our various exchange rates. Again, assets and liabilities at the current or end of year exchange rate of $1.50. Paid in capital, that is converted at the exchange rate that existed when we acquired our investment. So going back to January 1st, 2020, the exchange rate was $1.20 per euro. No specific exchange rate for retained earnings. Again, we carry that amount forward. Dividends declared converted at the rate on the dividend date. Revenues and expenses at the average exchange rate during the year. And again, note that we're carrying forward accumulated other comprehensive income on the dollar-denominated trial balance. That AOCI does not exist on the subsidiary's euro-denominated trial balance, of course, but in our working papers, last year we had $52,080 of other comprehensive income from that translation gain, and that flows through to accumulated other comprehensive income for the subsidiary's dollar-denominated trial balance. In any event, once we get all of those various exchange rates, we multiply across. Okay, so there are our dollar values for the various trial balance elements, and now we need to go ahead and figure out the translation gain or loss for the current year. So we add up our total debits, assets plus dividends declared plus expenses, $1,441,000. We add up our total credits, liabilities, equity accounts, revenues, and that AOCI from the previous year, $1,326,500. So to make this balance, we need $114,500 on the credit side. So we're going to put that in our dollar-denominated trial balance as a translation gain. And now to finish this out, we're going to need our dollar-denominated income. Okay, going over to our elimination entries, we do this in the usual fashion. We eliminate our beginning of year owner's equity accounts. The only new thing is that the accumulated other comprehensive income is one of the subsidiary's dollar-denominated equity accounts. We take that total and split it 80%, 20% between the parent's investment and the non-controlling interest. Now we need to eliminate our investment income. We have to eliminate both our regular investment income of $75,600 as well as our other comprehensive income of $91,600. We eliminate the dividends declared in the usual fashion, and now we need to go ahead and record the income of the non-controlling shareholders. They get their share, $18,900 of the reported earnings, plus they get their share, $22,900 of the $114,500 translation gain for the year.